You waited. You waited through the summer, through the fall. You watched 3 Fed meetings go by like a dog watching the mailman. Hopeful, alert, tail wagging. September cut, November cut, December cut. This is it, you thought. Spring 2026 is my window. Then, March 18th happened. Jerome Powell walked up to that podium, looked America's homebuyers dead in the eyes, and said, "Nothing is changing. No cut, no relief, no green light. Your spring window, boarded up." Now here's what's wild. This wasn't even a surprise if you knew where to look. The signals were there, but most people, and most financial media, were too busy celebrating the 2025 cuts to notice the storm quietly building underneath. In the next 10 minutes, I'm going to show you exactly why this happened, what it actually means for mortgage rates this spring, and, most importantly, what the people who saw this coming are doing with their money right now. Because they're not sitting around refreshing Zillow, they're moving. To understand what happened on March 18th, you have to go back to the last 3 months of 2025. The Fed cut rates 3 times in a row: September, November, December. Markets celebrated. Mortgage rates started drifting down. Homebuyers started making plans. And then 2 things happened that quietly blew that playbook up. First, inflation refused to die. The Producer Price Index, a leading indicator for consumer prices, came in at 2.9% in February. That's not a blip. That's the economy running too hot for the Fed's comfort. Second, oil. The conflict intensifying in the Middle East pushed crude prices sharply higher. Oil touching triple digits is effectively a tax on every business and every household in America. It flows straight into inflation data. The Fed saw the combination of hot PPI and rising energy costs and concluded, this is not the time to ease further. Now, Jerome Powell framed this as cautious optimism. They believe inflation is heading in the right direction, they just need more data. But read between the lines. Any rate cuts in 2026 are now a second half of the year story at best, maybe. And that has enormous consequences for anyone with a mortgage application sitting on their kitchen table. All right, let's talk about the mortgage market. And I want you to picture something. Imagine you've been at a bus stop for 6 months. You've been told the bus is coming. You've been assured the bus is coming. Rate cuts are the bus. You skipped a few houses, stayed patient, kept your powder dry. You are a responsible adult doing responsible adult things. The bus is not coming. The bus has been rerouted due to inflation. The bus is now scheduled for sometime in the fall, maybe, if oil cooperates. Here's the actual math. As of this week, the 30-year fixed mortgage rate is sitting between 6.11% and 6.18%. That sounds almost reasonable until you remember that 2 years ago, people were locking in at 3%. Those people are now sitting in their houses, sipping coffee, not moving, ever, because they're not giving up a 3% mortgage for a 6% one, which means inventory is thin, demand is compressed, and you, the buyer, are stuck playing a game where the rules keep changing. On a $400,000 home, moving from a 5.5% rate to 6.2% costs you roughly $175 more per month. That's $2,100 a year. Over a 30-year loan, you're looking at $63,000. That's a car, a very nice car, a car that you are handing directly to your lender because you waited for a rate cut that didn't arrive. I'm not trying to make you feel bad. I'm trying to make you feel appropriately annoyed, because productive annoyance leads to action, and action is what we're here for. So if rates aren't dropping, what are you supposed to do? Honestly, stop asking the Fed for permission to live your life. There's a specific playbook for this exact environment, and it doesn't involve sitting on the sidelines watching mortgage rates like they're a sports score. Stick with me, because the second half of this video is going to show you exactly where smart money is moving right now. Let's be real about where buyers fall right now. There are 2 types of people watching this video. Type 1, you're financially ready, pre-approved, and have been waiting for the perfect rate. Here's the uncomfortable truth. The perfect rate is a myth, right up there with perfect timing in the stock market and I'll start eating healthy on Monday. The buyers who win in 2026 are the ones who stop optimizing for a rate they can't control and start optimizing for a price they can negotiate. Less competition this spring means more leverage. Use it. Type 2. You genuinely cannot afford today's rates on the home you want. That's a real situation, and it deserves a real answer, not just be patient. You're looking at adjustable rate mortgages, seller-paid rate buydowns, or simply recalibrating your price range while you build more down payment. None of those are fun answers, but they beat another 6 months at the bus stop. Now here's the part of this story that almost nobody is talking about. While the mortgage world is frustrated, something quietly significant is happening in equity markets. Higher for longer rates don't just hurt borrowers, they change the entire math of which investments make sense. When money is cheap, you take risks. When money is expensive, you demand reliability. And right now, we're watching a major rotation in real time. The NASDAQ, which has been powered by speculative AI and tech plays, is under pressure. Meanwhile, ETFs like SCHD, the Schwab US Dividend Equity ETF, are up roughly 12% year to date. Think about that. A fund full of boring dividend stocks is quietly crushing the AI hype plays in 2026. Why is this happening? Because when interest rates stay high, companies that were funded on cheap debt, burning cash, growing fast, promising future profits, suddenly look a lot less attractive. The cost of capital just went up. The math on their valuations gets harder to justify. Quick pause, because this next part is genuinely wild. Did you know that Pepsi, yes, the company that makes a soda your dentist hates, has outperformed the NASDAQ over the last 40 years? Not venture capital, not options trading, not a single AI buzzword. Pepsi, Frito-Lay, Gatorade, the most boring shelf in the grocery store, has been quietly printing money for 4 decades straight. There's actually a name for stocks like this. Wall Street calls them dividend aristocrats, companies that have raised their dividend every single year for at least 25 consecutive years, through recessions, rate hikes, dot-com crashes, a global pandemic, every single year. And right now, in a higher for longer rate environment, they're not just surviving, they're being actively hunted by institutional money rotating out of speculative tech. Which brings us back to why this matters for your portfolio today. A company like Pepsi or a firm like Blackstone, businesses with real earnings, real dividends, and genuine pricing power thrive in an environment where capital is scarce. They don't need cheap money to survive. They generate their own. That's not a coincidence. That's the entire point. This is what Wall Street calls the shift to quality and value. And historically, this rotation happens at exactly this moment in the rate cycle, after central banks have signaled they're in no rush to cut. We're in that moment right now. The question isn't whether this rotation is real. The question is whether you're positioned for it. So we've covered the Fed's logic, the hard reality for mortgage hunters, and now the quiet reshuffling happening in markets. The one piece left, and honestly, the most actionable part of this video, is what you should actually do with all of this information starting this week. That's next. Don't go anywhere. Let's make this concrete. Whether you're a buyer, an investor, or both, here's how to position yourself for a world where rates are plateaued through at least mid-2026. Step 1. Stop waiting on rates to save you. If you're a prepared buyer with a strong down payment and stable income, a 6.2% rate is not the catastrophe it's being treated as. Run the numbers based on today's reality. The house you buy now with a 6.2% rate can be refinanced if rates eventually fall. The house you didn't buy because you were waiting cannot be purchased retroactively when competition picks back up. Step 2. Lock in high yield while you can. High yield savings accounts and short to medium term CDs are still paying between 4.5% and 5%. That's real money. If you have capital sitting on the sidelines, park it in a 12-month CD right now while those rates exist. When the Fed eventually cuts, those yields disappear fast. Step 3. Rebalance toward quality. If your portfolio is overweight in speculative tech or AI names that ran up 40 to 60% in 2024 and 2025, this is your natural trimming moment. Take some of those gains. Rotate a portion into dividend-focused ETFs like SCHD or individual quality names with pricing power. You're not abandoning growth. You're acknowledging that the rate environment has changed the rules. Step 4. Watch the second half of 2026 closely. If oil prices stabilize and PPI cools toward 2.3 to 2.5%, you could see the Fed move in September or November. That's when mortgage rates could drift meaningfully lower, and that's when the waiting game might finally pay off. Set a calendar reminder. Have your finances ready. Be prepared to act fast when the signal comes, because the market will move before the headlines do. The Fed didn't betray you. They're just doing exactly what their mandate tells them to do, fighting inflation, even when it's painful. The question is whether you're going to sit and wait for them or adapt your strategy to the world as it actually is right now. Smart money adapts. It always has. If this kind of no-nonsense breakdown is what you're looking for, no hype, no predictions, just clear analysis of how economic decisions affect your actual financial life, hit subscribe. We do this every week. You won't regret having it in your feed. And I want to hear from you. Are you a buyer who's been waiting on the Fed? Has this changed your thinking? Drop a comment below. I read every single one. And if there's enough of you in a specific situation, I'll build an entire video around it.